My name is Glenn Setchfield. I'm the VP of Marketing for DMI. And just welcome to our DMI University webinar series, where we explore agent topics related to sales, marketing, and operations that make a difference in your business. Today, we're going to discuss some of the most important financial planning concepts for women, including maximizing tax efficiency, Social Security, and healthcare or long-term care. And today, we're very lucky to have Doug Ewing of Nationwide. We have a great relationship with Nationwide, and I'm excited to hear this presentation by Doug today. And then also Jason Lang, VP of Annuity Sales for DMI. I'm not going to say too much here. I just wanted to kind of kick things off, but just be aware that we're muting and blocking participant video during the presentation, but we'll open it up at the end of our presentation for Q&A. So I'm going to just hand it off to Jason and let him say a few words.
Sure. Thanks, Glenn. Everyone can hear me fine?
Yeah, you sound good.
Okay. So as Glenn said, my name is Jason Lang. I'm one of our annuity VPs here on the sales side of things. And today is another great opportunity for us, to work with another one of our tremendous partners. I'd say because we've had such a long and successful relationship with Nationwide, it allows us to have some of these, terrific opportunities like today, where we get to bring in someone like Doug and really help educate, some of the agents and advisors like yourself. So just a real quick intro on Doug. He is part of the Nationwide Retirement Institute. He's an attorney. He's a CFA. He's even sat, he's been an advisor for, I believe, 5 years, I think Doug told me. So he sat on the same side of the desk as you. So a lot of the, challenges that you face in your day-to-day business, he's gone through as well. In addition to working with, several of the top insurance carriers out there. So I won't embarrass him too much and sing a lot of his accolades. I'll kind of stop there, but just a kind of quick overview of someone who, is going to be running this presentation. We didn't reach out and try to grab a 22-year-old kid off the street. It's really a seasoned vet like Doug. So I'll stop there. I think Glenn did mention we are going to open it up to questions and comments at the end. So if anything comes up, feel free to chime in. And if there's something that's really kind of specific to your situation, we may take that offline to kind of give you the time and attention that question might deserve. So I'll stop there, and Doug, I'll let you take it away.
All right, Jason, thank you very much. And good morning or good afternoon, everyone, depending on where you are. Again, my name is Doug Ewing. I'm with the Nationwide Retirement Institute, and I want to thank everybody at DMI for giving us the opportunity to be with you here today. Now, our topic today is women in retirement. I think it's only fair that I begin by addressing the 800-pound gorilla in the room, and that is, I am not a woman. And some of you might be disappointed by that, but let me share a couple of thoughts with you that will hopefully give you a little bit of perspective on this presentation and how I'm going to approach it. First of all, I want to point out that this presentation was put together by my friend and colleague, Roberta Eckert. Some of you may know Roberta, and she put this presentation together. Unfortunately, she was not available today, so I'm pinch hitting for her, but it was put together with a woman's perspective. So that's a big issue. And even though I am a guy, I do have some perspective on this issue of women in retirement. I've been married for 26 years, and a lot of the financial planning that we have done in my house is geared toward making sure that my wife is taken care of and set if anything were to happen to me. I also have 3 very important women in my life who I draw a lot of experience from. My mom, who was a single mom and a professional person for much of her life, lives down on Cape Cod, Massachusetts, where I'm originally from. My stepmom, my dad's widow, was married to my dad for a number of years, ran a small business with him, but she has been widowed now for over 20 years. And so I've got to help her with her experiences. And then, of course, there's my mother-in-law back in Ohio, who just turned 87 years old. And she had a very different experience. My father-in-law passed away a few years ago. And one of the things that we're going to talk about today is the role that women play as caregivers. And that's something that my mother-in-law had to deal with. So that's my perspective. And I'm going to draw on all of those experiences as we go through the presentation today. Now, as we look at our important disclaimer slide, I think this is always a good opportunity to, again, talk a little bit about my background. As Jason mentioned, I am an attorney by training. I practiced law for a long time back in Massachusetts, where I'm from, before I got into the financial services world. I'm also a CFP, Certified Financial Planner, not a CFA, but while I do like to mention that, I think it's important to point out that I'm not here today to give anybody tax or legal advice. And we recognize that you, as financial professionals, also don't give tax and legal advice. But what we can do, especially with women clients, this is incredibly important, is we can provide education. We can make sure that our clients are really well informed about the various issues that we're going to talk about here today. So we've got a lot to cover. Let's jump right into it. So here's our agenda. And what we're going to start by is looking at some of the realities that women face and how they impact their retirement readiness. And then we're going to address what I would consider to be probably the three most important financial planning topics for women as they approach retirement. We're going to talk about tax efficiency and the impact that that can have on portfolio longevity. We're going to talk about Social Security. Social Security claiming decisions are incredibly important for women. Why? Because women are very much likely to live longer than their spouses. And then we're going to also consider healthcare and long-term care. Because again, as we're going to talk about, longevity is a huge issue for women. And one of the most important things that we can do as financial professionals is help our women clients be prepared for the longevity that they are likely to encounter as they make their way through retirement. So let's start our discussion by looking at this idea of reality for women, right? What are some of the really key issues that impact women as they try to prepare for retirement? And the first thing we're going to look at is women's role as caregivers. Now, this is reality for many women, and it really doesn't matter if you're single or if you're married. Many women are going to spend at least a portion of their lives as caregivers for other people. It could be raising children. It could be taking care of an elderly parent, right? That's a huge issue for many people. And it could be taking care of a spouse. As I mentioned, that was something that my mother-in-law had to deal with as for a big chunk of her retirement. So the statistics that we see on the screen, an average of 24 hours a week spent as a caregiver. And that includes, raising kids, taking care of elderly parents, maybe an elderly spouse. The bottom line is that many women will spend as much as 4.5 years as caregivers. And usually what that means is they're going to be out of the workforce for that period of time. As we all know, most women work now, but caregiving can take women out of the workforce. And that can have a couple of important implications. First of all, the less time we have in the workforce, that means the less time we have where we are actively saving for retirement, right? We're not going to necessarily have access to that 401k or that qualified retirement account that's going to allow us to get money set aside for retirement. So that's a big issue. But another really big issue is taking time out of the workforce can impact Social Security benefits. So when we think about our Social Security benefit, our retirement benefit, what a lot of people don't realize is the way that Social Security calculates our benefit when we retire is they look at our 35 best years of earnings. And they index those for inflation and they average them out. They come up with something called our average index monthly earnings. And a question that we get a lot from women as they approach retirement: what if I wasn't in the workforce for 35 years? Does that mean that I'm going to have zeros averaged into my average index monthly earnings? And unfortunately, The answer to that is yes. So time out of the workforce can mean a significantly reduced Social Security benefit. And so if women are impacted, if they have this smaller Social Security benefit, what that means is, as financial planners, what we really need to be tuned into is how can we help maximize Social Security for women retirees? And we're going to look at that in quite a bit of detail in just a few minutes. Now, I do want to point out, I noticed we just got a question. I will occasionally try to. We had a question about a recording. I do believe. Well, I'm going to let Jason and Glenn address that at the end of the presentation. I just want to let everybody know I'm probably not going to be checking the questions as we go through the presentation, just because it's very distracting. So if you do have a question, please feel free to type it in the Q&A box. What I'll do is I'll make sure we address them at the end of the presentation. So thanks. Okay, so time out of the workforce is a big issue for many women. Another issue that I've already alluded to that is incredibly important is the issue of longevity. And so when we look at the average life expectancy for a healthy 65-year-old woman, it's almost 87 years old. And there's a different way we can look at longevity, and that is based on probabilities. And when we consider women, the numbers are pretty impressive. There is a 50-50 chance that a 65-year-old woman will live to be 88 years old. There is a 25% chance of a healthy 65-year-old woman living to be 94 years old. That is really amazing. But I will tell you what, based on my experience, there is nothing surprising about these numbers. I was telling Glenn as we were waiting for the webinar to start, my mother-in-law back in Ohio is 87 years old. You know what she's doing right now? She's building a new house. So obviously she's planning on being around for a while. If you told me that my mother-in-law is going to live to be 100 years old, would I be surprised? Not at all. And when I think about my experience, as I mentioned before, both my mom and my stepmom are back on Cape Cod. And, I go down there, I get out there as often as I can to spend time with them. And the one thing I notice when I'm on Cape Cod is it's all women, right? It's my mom and all her friends and my stepmom and all her friends. There's not a guy to be found. So not only are women likely to live a long time, but they are very likely to outlive their spouses. So that is something that we really want to consider when we're making our financial planning recommendations for women as they approach retirement. So as we go through the presentation today, here's what we're going to look at. We are going to look at tax efficiency. We are going to look at Social Security. We're going to look at healthcare. Because the bottom line is this: more than 25% of women do not have a plan to protect themselves against outliving their retirement savings. And so when we think about that, when we think about longevity, and we think about the lack of a plan to avoid outliving our retirement savings, we can see how important the tools that we have available to us as financial professionals are going to be in this process. Annuities and life insurance in particular are critically important for women as they approach retirement. So we're going to keep coming back to that as we go through the presentation. All right, so the first thing we're going to address in terms of financial planning strategies is tax efficiency. And when you think of that, it's tax efficiency. Why is that so important to women? Well, the bottom line is this: if women are likely to be single in retirement, they are likely to be very tax sensitive. Because when we think of single filer tax status, I wish I had a slide in this presentation, unfortunately I don't. But when we think about single filer tax status compared to married filing jointly, what we find is that the brackets are more narrow. Single filers they have a smaller standard deduction, and they get to higher income tax brackets at lower levels of income. So one thing that we want to think about, especially for our women clients who are currently married, is taking advantage of married filing jointly tax status to relieve the burden on women when they ultimately become single. I'm going to expound on that in just a few minutes. But when we think about how to become more tax efficient in retirement and how that impacts women, remember that the way we prepare to be more tax efficient in retirement is to take advantage of opportunities while we are saving for retirement. So one thing we talk a lot about at the Nationwide Retirement Institute, in fact, we've got an entire presentation on it, is how we can help people be more tax efficient, and it's all about tax diversification. So as we save for retirement, are we taking advantage of different savings vehicles that are available to us to diversify across different accounts with different tax treatment? So ideally, what we want to do is we want to have some of our retirement savings in what we would call taxable accounts. And that could be a non-qualified brokerage account, anything really that has that capital gains exposure. We could even lump like real estate into this particular category. And also something as simple as a savings account. When we talk about that taxable account, really all we're talking about are accounts that are not tax deferred, but might get the benefit of long-term capital gains treatment down the line. So think about that non-qualified brokerage account, right? If we're working on an account like that, one of the advantages to an account like that, when we think about planning for women in retirement, you're going to get a step up in cost basis when one spouse dies. And that means that, you can avoid having to pay capital gains taxes on some of those assets. So taxable assets are important. Now, tax deferred assets are also important. And I'll tell you what I've found in my experience over the years is that for most of your clients, most of their assets are going to be held, most of their retirement assets, I should say, are going to be held in tax deferred retirement accounts, 401ks, 403bs, whatever it is. Those tax deferred accounts are going to play a huge role in the retirement savings of most of our clients. Now, what's the issue with tax deferred retirement accounts when it comes to women in retirement? Well, for one thing, that money has never been taxed. As we know, those are tax deferred contributions. So that money, when we pull it out in retirement, is going to be fully taxable. But another issue, we're going to see an example of this on the next slide, where having tax deferred accounts can be somewhat problematic for women in retirement, has to do with required minimum distributions. So I'm going to go out on a limb and suggest that for most of your married clients, when they have tax deferred retirement accounts, they are making each other, husbands and wives, they're making each other the primary beneficiaries of their accounts. And what can happen with married couples is husband passes away, wife is the primary beneficiary of tax deferred retirement accounts. As we all know, the wife can now take over those accounts, make herself the new owner. But assuming that the husband and wife are around the same age, you know what's going to happen there? Any required minimum distributions that the husband was required to take before passing away, well, now when the wife takes over that account, assuming they're around the same age, her RMDs are not going to change that much. But what is going to change is the surviving spouse's tax status. We go from married filing jointly with nice wide tax brackets and a big standard deduction to a much smaller standard deduction, much more narrow tax brackets. And that can leave a surviving spouse with a bit of a tax headache. So one thing we want to consider with tax deferred retirement accounts is maybe drawing those accounts down while the couple is married, so that the RMDs later on aren't quite as big. Now, when I use that term drawing assets down, sometimes that alarms people and they think, oh, well, we don't want to spend too much of their retirement savings because that will, cause problems down the line. I'm not saying spend that money. I'm saying move it out of tax deferred accounts, right? Maybe do a small Roth conversion, right? Maybe park it in a non-qualified brokerage. Maybe use some of those distributions to pay the premiums on life insurance, right? These are ways that we can get money out of these tax deferred accounts, get that tax diversification. Because when we look at our last category of assets here, tax-free assets, this is where many clients are lacking. Many clients have not taken advantage of the opportunity to fund Roth accounts through their qualified retirement plans at work. They haven't necessarily done Roth IRA contributions because many clients make too much money for that. And many clients have not taken the opportunity to take advantage of permanent life insurance. Permanent life insurance is an incredibly effective way for couples to build a potentially tax-free bucket of money in retirement. So again, there's a million reasons why life insurance is important for a surviving spouse. And for women in retirement, tax efficiency is one of those reasons. Now, what we're going to see on this slide is why this is important, because if we can help our clients be more tax efficient, we can help the women we serve be more tax efficient, we can save them money in retirement. So what are we looking at on this slide? Well, this is very simply the way that we calculate Medicare Part B premiums. So as most people know, when we turn 65, typically we go on Medicare. What many people don't know is that when we go on Medicare, we have to start paying premiums for our Medicare Part B coverage. And those premiums are means tested. So the higher your income is, the more you will pay for your Medicare Part B premiums. Now, when you're married, what you see, and we're looking at the top row on this chart, what you see is when you're married, in order to have the minimum Part B premium, all you have to do is keep your modified adjusted gross income under $182,000. If you can do that, you're going to pay the minimum for Part B. Now, a lot of people say, $182,000, that's how hard is it to keep your income under $182,000? And for many couples, it's not that hard. But look on the left side of the chart. Look what happens when a widow becomes a single or an individual filer. The threshold for those Part B premiums is only $91,000. So now, as a surviving spouse, as a widow, if your income is over $91,000, you can start paying substantially more for your Medicare Part B. And that usually comes out of somebody's Social Security check. So now you're dinging that Social Security check. So this is a really good example of why married couples should take advantage of their status. And you want to avoid those large RMDs later on, because, when people ask, well, why would somebody have a problem keeping their income under 91,000? Usually what it is, it's required minimum distributions from tax deferred retirement accounts. So that's why we want to address tax efficiency as we prepare for retirement, because that's going to directly impact a surviving spouse, many of whom are going to be women. Now, another thing we can do as we prepare for retirement is take advantage of health savings accounts. Now, I'm not going to spend a ton of time on this, but as many of you are aware, if you participate in a high deductible health plan, you have the opportunity to contribute to a health savings account. A married couple filing a joint return with both spouses over the age of 55, you could be getting $9,200 a year into a health savings account. Now, again, you have to have a high deductible health plan in order to do this. But what's really interesting about HSAs is they are triple tax free. The money goes in pre-tax, so it's lowering our taxable income when we make the contribution. Once that money is in the HSA, most HSA accounts are going to allow you to invest the money in a menu of mutual funds, much like a 401k. But when you pull money out of a health savings account later on, as long as you're using that money for a qualifying medical expense, money comes out completely tax-free. So that's a pretty unique animal under the Internal Revenue Code. And for women, HSAs can be a wonderful cushion if you have an HSA when you go into retirement, because we're going to talk about healthcare costs a little bit later in the presentation. But for things like copays and deductibles, especially for prescription meds, like that's a huge, like I talked to my mom and she complains about, her healthcare costs. What's the number one thing she always talks about? Prescription drugs. HSAs are a wonderful place you can tap into to help cover those costs and do so in a very tax efficient manner. So keep HSAs in mind. Now, what I want to just quickly close with is show you how having some tax diversification can help people in retirement. And let's see, I'm trying to get through that. Good. Okay, so here's a quick example. We're going to take a look at two couples here in retirement. And so here's our scenario. Both of our couples typically get by on $100,000 a year of taxable income. But this year, both of our couples are going to have some additional expenses. For one thing, they're going to take a vacation. That's going to cost $10,000. The other expense they're going to have is someone's having a hip replacement, and that's going to cost another $10,000. Now, if we have all of our assets concentrated in tax-deferred retirement accounts, when our couple number one here needs that extra $20,000, what are they going to do? They're going to dip into their tax-deferred retirement account. That's going to add to their taxable income. Then when we apply the tax brackets and we calculate their taxable income, what we see is they're going to have a federal income tax bill of just over $18,000 for the year. But if we can help our clients have a little bit of tax diversification, like we've done here with couple number two, when couple number two needs their additional $20,000, they have options. So for the vacation, they're going to take $10,000 out of their Roth account, which, by the way, is a great way to leverage a Roth account. Roth accounts are perfect for fun stuff like vacations and buying a boat, whatever you're into. And that doesn't add to their taxable income. That's a tax-free distribution. For the hip replacement, they're going to go to their HSA. And again, for qualifying medical expenses, an HSA distribution is completely tax-free. So when we look at couple number two, they're not increasing their taxable income. When we calculate their tax bill based on $100,000 of taxable income, we see that their tax bill is substantially less, not even $14,000. So that's just a quick example of how having some tax diversification can help us keep our tax bill low in retirement. And this works for married couples. It also works for single filers. So it can be very beneficial to women in retirement to have some tax-free money available. And Roth accounts and life insurance are great ways to do that. So some things to think about with tax efficiency. Some clients may want to take advantage of Roth 401k. Roth conversions can be a good strategy, but typically where you're going to want to look at Roth conversions very early in retirement when the client doesn't have a lot of other income. Because if you're going to do conversions, small annual conversions, taking advantage of lower tax brackets are very important. Take advantage of an HSA. Now, for your married couples, here's something to think about. Make sure that they are taking advantage every single year in retirement of their standard deduction, the 10% and the 12% brackets. These are very low brackets by historical standards. And that's the standard deduction for a married couple where both spouses are 65 plus, $28,700. So take that opportunity to draw down those tax deferred accounts. If they don't need the money, that's the perfect time to do a Roth conversion. Fill up that tax-free bucket. That's going to have huge benefits to that surviving spouse later on. Okay, now let's take a look at Social Security, because Social Security is going to be an incredibly important source of income for many women in retirement. So we want to understand how it works, and we want to help people make the best possible decision. Now, the first thing we're going to look at, this is kind of a fun statistic. A lot of people think they know how to maximize their Social Security benefits. In fact, 54% of people tell us they know how to maximize their Social Security. And yet, when we ask those people, okay, tell us what you do to maximize your Social Security, only 6% of people can answer that question. So the first thing we want to think about when it comes to claiming Social Security is understand full retirement age. This is so important. A lot of people, when you ask them what's full retirement age, what are they going to tell you? Oh, it's 65. 65 is an important age. It's when we sign up for Medicare. But 65 is not full retirement age for Social Security. What we see on this slide is that full retirement age for Social Security is going to be between 66 and 67, depending on when you were born. One of the things we want to impress upon people is trying to wait, if you possibly can, until at least full retirement age to claim your Social Security benefit. Why is that so important? Well, let's take a look at what many women do in retirement. So if we look at this slide, what we see is that actually just about half of women will claim Social Security before full retirement age. And 26% of women will claim Social Security in the very first year that they are eligible, 62 years old. Why is that significant? Well, as we all know, Social Security allows you to claim early, but what happens when you claim early? You get a smaller monthly check, and that smaller monthly check is going to follow you all the way through retirement. So when we're working with women clients, we need to educate them on the impact of claiming Social Security early. Now, what you'll see on this slide is that just a handful of women, only about 8%, will wait until 70 to claim Social Security. And you may wonder, well, why would anybody wait until 70 to claim Social Security? Well, just like if you claim at 62, you get a smaller monthly check. When you claim at age 70, you are going to get a larger monthly check. And here's what's really important. So let's say we have a single woman and they're looking at Social Security. Now, this slide is a little bit flawed in that we don't know exactly what this person's primary insurance amount is, but here's the bottom line. If we claim at 62 and we live in, so for a woman client, if we live to be 85 years old and we claim at 62, we'll get about $706,000 in benefits. I believe this is based on a primary insurance amount of around $2,500 a month. If we wait until 66 years and 6 months, that cumulative lifetime benefit goes up to $822. That's a 16% higher benefit on a cumulative basis. But if we wait until age 70, look what happens, a 25% bigger cumulative lifetime benefit. That is more Social Security income. Now, a question that a lot of people are going to have is, if I wait until age 70 to claim Social Security, how long is it going to take me until I break even on that decision? Because remember, if I'm delaying Social Security until age 70, there's a cost in doing that. That means I'm going to go from, say, full retirement age to age 70 without receiving any Social Security income. So how long does it take to break even? Usually it's by around age 82. Usually if you decide to wait until age 70 to claim Social Security, you will break even on that decision by about 82 years old. But what have we seen thus far? Women on average are likely to live well beyond 82 years old. So, I mean, if you have a health issue and you're concerned that, you just don't think you've got that kind of longevity, well, claiming early can make sense. But if we're protecting against that longevity that we've already seen, that's when delaying Social Security can make a lot of sense. Now, here's another issue to be aware of with Social Security. A lot of people want to know, well, I'm thinking about claiming Social Security, but I'm still working. Does that make sense? Here's the bottom line. I'm not going to get into a ton of detail on this, but the bottom line is this. If you are still working and you are not full retirement age yet, claiming Social Security benefits early is rarely going to make sense. And that's because prior to full retirement age, if you are working and receiving Social Security at the same time, Social Security is going to withhold some of your benefit. Now, this slide needs to be updated. Currently, if we look at the far left, currently the threshold's about $20,000. So for every $2 you make above $20,000, that's going to result in a dollar of your Social Security benefit being withheld. Now, the withholding's not that big of a deal because eventually you get that money back. It gets factored back into your benefit, and you'll get that money back over time. But the problem with withholding is it's very inefficient. It's very confusing. So I would really encourage people, hey, if you're still working and you've got income, don't claim Social Security. Now, once you hit full retirement age, you can work, you can collect Social Security, no problem. But prior to that, that's where you got to watch out. Now, when we look at issues unique to women, now all of the Social Security rules are gender neutral, so these are not specific rules for women, but we do want to be familiar with the spousal benefit and the survivor benefit. These are very important. So the spousal benefit is designed to provide a benefit to a spouse who either did not work or just worked enough to qualify for Social Security, which is about 10 years, but doesn't have a very large benefit. And what the spousal benefit says is once the spouse with the higher Social Security benefit turns their Social Security on, the other spouse, even if they don't qualify for Social Security on their own or they qualify for a very small benefit, can get a spousal benefit. And that spousal benefit is up to 50% of the other spouse's primary insurance amount. So if we have a situation where husband has a benefit of $2,000 a month, and he turns that benefit on, we have a wife who maybe only qualifies for about $500 a month of Social Security because of taking time out of the workforce, all that stuff we talked about. That spouse can get up to $1,000 a month just based on the other spouse's record. Now you have to wait until full retirement age to get the full 50%. You can claim as early as age 62, but again, if you do that, once again, you're looking at a reduced benefit. Now, the good news is the spousal benefit is not as important as it used to be. In fact, the last year I've found numbers on, back in 2017, only about 20% of women were even taking the spousal benefit. And the reason for that is if you have your own benefit and it's more than 50% of your spouse's benefit, you're just going to take that. So I look at my wife, she's never going to take a spousal benefit off of my record because she's worked enough that her Social Security benefit is well in excess of 50% of my benefit. So when the time comes for her to claim, she's just going to take her own benefit. But still, you do want to be aware of the spousal benefit. Now let's talk about the survivor benefit. This is really important. And I think the easiest, quickest way to explain the survivor benefit is to walk you through a quick example. So let's say my wife and I are both retired and we're both on Social Security. I'm getting $2,500 a month and my wife is getting $1,500 a month. Question is, what happens if I die? Well, the good news is that my $2,500 a month benefit becomes my wife's survivor benefit. So she goes from getting $1,500 a month to getting $2,500 a month. That's the good news. What's the bad news though? As a household, we were getting $4,000 a month. And now, as a survivor, as a widow, my wife's going to have to get by on $2,500 a month. That's a big deal. So what are some things we can do to protect a spouse? Well, one thing I could do is I could wait to claim Social Security until I'm 70. Because if I do that, my $2,500 a month benefit is going to grow probably to around $3,000 a month. And when I lock that benefit in for myself, you know what else I'm doing? I'm locking it in for my spouse. Now, when I die, my spouse is going to get $3,000 a month because I maximized my benefit. That's very important. What are some other things I can do? Well, I can tell you what I have done. I've put some of my IRA money in a variable annuity with a guaranteed minimum withdrawal benefit, a joint guaranteed minimum withdrawal benefit. So when I turn 65, I'm going to turn that income stream on from that annuity. And you know what? It's going to last not just for my life, but because I chose the joint lifetime benefit, it's going to pay for my life. And when I die, it's going to pay my wife until she passes away. So annuities with joint lifetime income benefits are really, really effective as a way to complement Social Security. What's another thing I can do? And I have done, life insurance. If I die, there's going to be a tax-free life insurance benefit that is going to go to my wife, and it's going to allow her the extra income she needs to deal with that inevitable drop in Social Security income. So survivor benefits are really important. We want to maximize those, but we also need to have a plan for when one spouse dies. Now, let's talk a little bit about divorce. This is very important because we know that divorce rates among seniors, sadly, have gone up in recent years. When you are dealing with clients who have been divorced, remember this. As long as the marriage lasted long enough, and the magic number is 10 years, as long as that marriage lasted for 10 years, even though that couple got divorced, each spouse maintains rights against the other spouse's Social Security record. And here's a really important rule to remember. A lot of people think, oh, my ex got remarried, so I'm out of luck now for Social Security. No, that is not true. If an ex-spouse gets remarried, it does not impact the other spouse. So if you're working with a woman who has, been divorced and the husband gets remarried, it doesn't impact that divorced spouse at all. If she needs to claim a spousal benefit based on her ex's record, she can do that. If she needs to claim a survivor benefit when her ex dies, she can do that. Now, the big issue, as I just mentioned, when it comes to divorce is remarriage. We don't care if your ex gets remarried, but if the other spouse gets remarried, so let's assume we're working with a woman, if she gets remarried, it can impact her rights to claim on her ex-spouse's record. For one thing, if you get remarried, you can no longer claim a spousal benefit based on your ex. And that makes sense because you have a new spouse now. You can claim a spousal benefit based on your new spouse. But when it comes to survivor benefits, the rule's a little trickier because now we don't just care if you get remarried, we care when you get remarried. And the age to watch out for is age 60. So if you get remarried before you turn 60 and your ex dies, you do not get to claim a survivor benefit when your ex dies. But if you get remarried at age 60 or later, and then your ex dies, guess what? You can claim a survivor benefit based on your ex's record, even though you're now married to somebody else. So, I know a lot of clients don't come to you for marriage advice, but if you're dealing with a woman who's looking at a second marriage and they're close to their 60th birthday, one great piece of advice you can give them is push the wedding date beyond your 60th birthday. That way, if something awful happens to your ex, guess what? You get to collect a survivor benefit. So that's really important stuff. Now, one last thing about divorce I'm going to touch on really quickly. Sometimes people want to know, I was married for 10 years, got divorced, got married again. Second marriage only lasted a few months, didn't really work out. Can I still go back and claim on that first ex? And the answer is, as long as you are currently unmarried, yes, you can still go back and claim on that first ex. So this stuff, obviously, for women clients, this is really important stuff. So hopefully that's something you guys find helpful. If you have issues or questions about Social Security, keep in mind, Nationwide has a wonderful tool available called our Social Security 360 Analyzer. You can find this at nationwidefinancial.com, and it is a tool you can use that will help couples, widows, divorcees, figure out what's going to make sense for them from Social Security. You get a nice report. It's a really cool tool. Okay, I'm going to pick it up here a little bit here. We're going to take about 5 minutes here. Let's talk a little bit about long-term care and health needs. One thing to be aware of is that we have to plan for healthcare costs because healthcare costs generally go up much faster than the rate of inflation generally in the economy. Now, this slide's a little bit dated in that it hasn't taken into account the most recent increase in Social Security, which we saw in November, about 6%, thanks to a big jump in inflation in the economy. But healthcare costs are a big issue. Now, a lot of people wonder, it's like, well, wait a minute, if I'm going to be on Medicare, why do I need to worry about healthcare costs? Well, here's the thing to keep in mind. Medicare is only going to cover about 60% of our healthcare costs in retirement. So as we look at this chart, and when we look at medical expenses, Medicare is going to cover about 60%. Then we're going to need private supplemental insurance to go along with Medicare. Either Medicare Advantage or Medigap, there are costs associated with that. Even with supplemental coverage, you're going to have out-of-pocket expenses for things like prescription drugs. So we do need to plan, and we do need to make sure that people are adequately insured. Now, a couple of other things we can do, in addition to making sure that they've got good supplemental health care coverage, either Medigap or Medicare Advantage, is, again, have they saved to cover these costs? Health savings accounts. If you've got a health savings account when you go into retirement, that's a tax-free bucket of money you can dip into to cover healthcare costs. But for many women, one issue that they're going to want to address is potential long-term care needs. And when we think about long-term care, what exactly are we talking about here? Well, it's the services and the support you need to live as independently as possible, up to and including the point where you can no longer perform everyday activities on your own. I got some sad news, last month I found out that my mom has been diagnosed as being in the very, very early stages of Alzheimer's. So long-term care is obviously a big issue with us. I consider myself incredibly fortunate. My mom was also a certified financial planner, and because of that, she got long-term care insurance. And so now we know that I live in Colorado, she lives on Cape Cod, right? I can't be there all the time. But now we know when the time comes for somebody to come into the house and help her with the things she's going to need help with, we've got that covered. Now, there are a lot of myths. And when we talk about client education, here are some really important things that people need to understand. Medicare does not cover long-term care. And by long-term care, we're talking about custodial care, help with the so-called activities of daily living, getting out of bed, using the bathroom, bathing, eating, dressing, all of that stuff. There's no coverage there in Medicare for that. Medicare will cover your health expenses, but not the long-term care expense. Same thing with health insurance. It will cover your health care expenses, but not long-term care. Now, another thing that's really important to point out is that long-term care does not mean going into a nursing home. And one of the things that makes long-term care insurance so valuable is that it actually helps people stay out of nursing homes by allowing people to afford care coming into the house and helping them stay where they want to stay. We know that in the aftermath of COVID-19, people are more adamant than they have ever been, that they want to stay home. Long-term care helps you do that. And of course, some people will say, well, my spouse can take care of me, but what have we already talked about? Women are not likely to have that spouse there to take care of them because they are very likely to live beyond their spouse. Now, this is not a long-term care presentation, and I don't want to get into a big, long discussion of long-term care, but I do want to make one important point about long-term care. If you are helping your clients look at long-term care coverage, remember this, there are two primary types of long-term care coverage. There is reimbursement coverage, and there is indemnity coverage. My mom has an old school long-term care policy that she bought 20 years ago. It is a reimbursement style plan. So as she incurs expenses, we're going to have to pay for those expenses, but then we submit those expenses to the long-term care carrier, and covered expenses will be reimbursed, but only covered expenses. Indemnity policies are a lot newer. And with an indemnity style policy, once you qualify for a claim, either due to severe cognitive impairment or you're unable to do 2 of the 6 activities of daily living, an indemnity policy is going to pay you the agreed upon monthly benefit. And you can generally take that benefit and you can spend it on whatever you need to. That can give you a lot more flexibility when it comes to long-term care. I'm going to let you guess which type of coverage Nationwide provides, but it is a big issue. So that's if you're showing long-term care to a client, I would strongly suggest take a look at the difference between reimbursement and indemnity. I think it's a pretty easy call for most people. So again, much like our Social Security report, we can also prepare a healthcare cost assessment and a long-term care cost assessment. So again, the easiest way to find this, and we'll make sure that we get it to Glenn and we'll get it to Jason. And so Glenn and Jason can get you these, the fact finders that we need to prepare these reports, but you can also go to Nationwide Financial and find these as well. But again, the report will give people a really accurate estimate based on their current health condition and their location of what they can expect to pay for both healthcare and long-term care in retirement. And this can be the cornerstone of a good retirement income plan. If you can help somebody, you can help your women clients feel more prepared for this aspect of aging. It's going to help you a great deal. So, okay, so we're just about there. Where do we go from here? Well, again, our Social Security 360, our healthcare cost assessment. I'm going to make sure that Glenn and Jason have these available so you can go to them and they can get you these tools. But when you're working with your women clients, just, remember, think about the financial and physical, the impacts of caregiving, not just the emotional impacts. It's a very difficult thing to do emotionally, but caregiving has financial costs. And, think about those as well. Try to be tax efficient. Take advantage of married filing jointly status while you can for your married couple clients so that we don't leave a surviving spouse with, huge RMDs that are going to cause them to lose a lot of their retirement savings to taxes. Maximize Social Security. Think about healthcare and long-term care costs. And, of course, by working with a financial professional, this is when, women are most empowered to deal with these issues that we've talked about here today. So with that, I am going to turn it back over to Glenn. I'm going to pop something up on our screen here. There we go. And Glenn, I will let you wrap it up. And while you're doing that, I'll take a look at the questions and see if there's anything I can help out.
Thanks so much, Doug. That's fantastic. I really appreciate the conversation today. Wonderful. We do have a question. Actually, you know what? I'm going to turn it over to Courtney. Courtney, what have we got as far as questions right now?